All right. Welcome, everyone, to this legal office hours. Today's topic, what killed deals in 2025? As Bill joked, this is a grim topic, but actually very important. James, David, and Bill have a very dense, lots of reasons that deals died in 25 presentation to give to you today. So this is going to be a really, really valuable one. The last one of the year, everybody. So you won't see webinars again until January. Bill and James David, I want to just say to you guys, thank you very much for all the webinars you've done all year round. These webinars have been a big part of the success of Acquiring Minds, and it's all because the webinar presenters, namely you guys, bring such great presentations, great content. So thank you for doing so many awesome presentations. I haven't even done any of the introduction. So my name is Will Smith, and I'm the host of the podcast Acquiring Minds and a partner in Minds Capital, a fund that invests in independent sponsor deals. James David Williams and Bill Barlow are today's hosts. They are partners in Barlow and Williams, a legal practice that specializes in small business M&A. They're at the front lines of our market. Their focus is helping searchers, sponsors like you all do your deals. Bill and James David will give their presentation on why deals died in 2025, and then we will do Q&A. If you have a question as we go, use the Q&A button. If you have a deal detailed question on maybe a live deal and you have an actual issue that's maybe a little bit more in the weeds that it makes sense to air live in this presentation or in the Q&A section of this presentation, put it in the Q&A anyway, and James David will spend his Christmas holiday responding to you. And here are a few links to get in touch with these gentlemen, their website and their LinkedIn and email addresses. Connect with them both on LinkedIn. And with that, guys, over to you.
All right. Thank you very much, Will. So just to give a little bit more background, these are deals that actually got under LOI and then subsequently died. There's many reasons why deals don't even get to the point of LOI, and that would be an even longer presentation. But the primary purpose for you is basically to see if there are certain patterns, certain types of issues that come up relatively frequently. So when you're evaluating deals, you can see, this is a kind of deal that might have that kind of issue. I'll also say as a preliminary matter, for a lot of these, it wasn't something that you as the buyer could have necessarily caught before you went under LOI. Some of these issues you just won't know. And so part of this process in learning this is you want to try and figure out these issues early, because if a deal has to die, you want to kill it as soon as possible so that you're not paying money for financial experts, for lawyers, for all that stuff. You want to keep your costs to a minimum. So as bad as it is for deals to die, if they have to die, die early. And also, frankly, what's worse than a deal that doesn't die is a deal that should have died and goes through anyway. And so we also want to avoid a situation where you actually close a deal and end up with a big problem. Luckily, that didn't happen to any of our clients, but that's another thing that hopefully we'll get out of this presentation.
Yeah. And I'll just say, right, this is by number of slides, longest presentation we've done in our Acquiring Minds run, which was really painful to prepare for. But these are also not the same. Right. Some of these had multiple transactions die for the same reason. Others are one-offs. So with that in mind, we'll move to the first reason, which is by far the most common. And this is probably accounts for something like half or even more of the deals that fall apart in the SMB space. And that is just the financials that were reported don't hold up, weren't accurate. Frankly, it's a miracle when the financials come back clean in the lower market. When you're doing your LOI, right, you have to assume that the financials you've been presented are accurate, and you have to present your offer as if they're accurate. but you need to build into your, kind of baseline assumptions that the financials are not going to be what they're reported to be. If it only falls 10% in the sort of SBA range, then, that's usually a good thing. We've seen them fall 40, 50%, uh, especially when it converts from cash accounting to accrual accounting. We've seen several where it turns out the business wasn't even making money at all by the time you actually did the quality of earnings. And because of that, right, the lesson is you will do a QOE. It is not optional. It is not an area where you want to try to skimp. It is a real necessary thing, even on a small deal, right? There are a lot of brokers who will say, oh, this deal is so small, you don't need to do a QOE. Right? Those can be the deals where you actually need to do the QOE even more. Uh, and I'll just say, like, we're not going to help you do a transaction unless you're doing a QOE. That's how strongly we feel about it. So uh, that's the lesson there. Now, Bill, on to number two.
Yeah, and this is kind of a corollary, which is especially when the financials show that the numbers are less than what were initially reported, you will often say, well, look, I was buying this based on a 4 times multiple of EBITDA. EBITDA went down by 20%, therefore I'm gonna lower my purchase price by 20%. This doesn't always work. Often sellers have a reserve price in mind. They're gonna only sell for a certain amount. We had a seller who came to us, was very excited about an LOI, but they didn't really understand their own books. And then after the buyer did the QOE and then, showed a very significant reduction, they said, unfortunately, we would just never sell our business for that, and so the deal died. So that's why if you see that, and often you might see this happening pretty early on when you start doing your quality of earnings. If you see that there's going to be some pretty major adjustments, and you see there's going to be that, have that conversation early. So don't just delay and wait until the full QOE is done, right? If early on you see there's going to be something, have that conversation, because if the seller is just not willing to do a deal, then there's no point in continuing on the process. Um, so
Yeah, and those, right, those first two, probably 60+% of the deals that died, if not more. And then we're going to have this long tail of other reasons that will get progressively weirder as it goes. But next is, declining business performance. Right? You're buying the business, right? You're going to inherit the business as it exists on the closing day, right? And the seller sometimes is thinking about, well, this is what my business was 12 months ago, 6 months ago, or this is what my business was during COVID or whatever, right? Sellers are locked to a high point, but like you're taking ownership of that business as it exists now. And sometimes that it leads to a big gap. Um, this can also affect the ability to actually get through underwriting if you're doing an SBA process, right? If the business is going down, it's really hard sometimes to get through underwriting. There can also be times when there's a decline in performance during the deal process, right? Post LOI even, right? That's a fairly common thing. You know, sometimes sellers are just coasting at that point. Other times things happen, right? We had one deal where a key customer chose not to renew between signing and closing, which affected the deal terms. Um, but it can just anytime there's that downward slide, you got to ask yourself, okay, is this, what's causing this slide? What's real? Because if it's something secular, something that's going to be a thing that's going to continue going forward, obviously that's a huge problem for you as a buyer.
and one thing I'll just note on this is why it's always good to ask for updated financials as the deal process goes along, because sometimes by asking for new financials, for the updated month, you see that declining performance that you might not have otherwise seen. Next one, leases. We saw several deals die. They went under LOI, and then the landlord was simply usually they were just going to say, okay, I'm not going to give you your term. Now, under the SBA, in general, you need to have the option to renew for the full 10 years of the loan. So you're kind of asking a bit from landlords to enter into that arrangement. There are some landlords flat out not willing to do it. Some landlords, they'll jack up the rent. Some landlords, they can do different things. So that's why one big mistake that we see people make is when they know leases are going to be an issue, have to have that conversation early. Because if the landlord isn't willing to do it and you're using SBA financing, your deal is just dead. That's just as simple as that. And even in non-SBA contexts, a lot of times you have to ask, is this location important for the business? And in many businesses it is. It's the place where customers, go. Not all businesses, there's some where it's just a warehouse and doesn't really matter. But the point is, if there are lease locations, that's something you definitely want to check, because multiple deals have died this year because of a problem with leases.
Bill, that one was yours too.
Yeah. So here, sometimes you get, and this is more common when we're talking about the independent sponsor land, but we had an issue where an independent sponsor got a deal under LOI, and then he went out to the market and said, okay, I got this deal under LOI. I'm very excited about that. And the market basically said part of it was because the financials ended up coming in lower. But even then, after retrading price, he went out to the market and said, hey, who's willing to sponsor this deal? And crickets. The equity investors simply were not interested. So whenever you're doing larger transactions that are independent sponsor, one of the key risks is you can't raise money for the deal. And partly that's a problem, obviously, if you can't raise money. Partly it's sometimes if it takes too long, then the seller is going to walk, because sometimes people have kind of made the seller believe that they have the money, even though they're going to raise the money. And then when it takes too long, the seller's like, what's going on? And then the seller loses confidence in your ability to close. And then the relationship sours. So our key here is, if you are raising money on the deal, make sure that the seller is apprised about the process early and kept updated often, because the last thing you want is a surprise that you can't make something, then that breaks trust. Always communicate that early, even though it might feel bad, because it might feel like they're not going to accept my deal. You got to keep the seller, you got to let them know about what's going on the other side of it.
And also, anytime, whether it's an SBA range or independent sponsor, like if you're raising money, if you need equity, start as early as you possibly can.
Yeah.
Because it will take longer than you think.
As soon as you get the signed LOI, go out and start that process.
And even earlier if people are willing to talk to you earlier.
Yeah.
Can I just say a point here, guys? One thing that comes up in independent sponsor land as a feature of independent sponsor deals versus private equity, there's, every independent sponsor deal, it is deal by deal. And so the sponsor goes out and raises the money, which to searchers is going to sound like, well, that's just how, of course, that's how it's done. But in traditional private equity, you raise a fund, and then inside the fund, the partners or whomever goes out and does deals, and there's just the internal investment committee. So it doesn't need to go through the same levels of basically market scrutiny. So if you're getting feedback from investors that nobody wants to invest, that also should be its own tell. Part of this is the art of being an entrepreneur. It's like maybe you have a vision and nobody else sees it, and that's why you're the entrepreneur and they're not. But it's also the market telling you something. If 10 smart people have looked at your deal and all said no, you should incorporate that feedback one way or the other. Maybe that's telling you something about the value of the deal itself.
Yeah.
And in that particular one, it was too late to try to change the terms by the time the market feedback came around. Next one, this one happened to me more than once. Key employees, um, right? If you were buying a small or service business, whether it happened in professional services, but it could happen in the trades too. Um, there are key people that you need to run the business post-closing, and those people are not happy with having a new boss or thought they were going to be the ones to get the business or whatever, right? Or thought they were going to get a big pay raise or whatever the case may be, then that is a problem, all right? Because without some of those key people, the business will collapse. So we had more than one this year where we got to the very end, everything was negotiated. It was time to talk to the employees, bring them into the deal, and the employees balked uh, for either compensation reasons or control reasons. In one case, the person thought that they were going to be the one to buy the business and seemingly hadn't even been told there was a process being run. So query whether you want to buy a business like that anyway, but it happened. Um, the lesson is if there are key employees, right, try to meet with them as soon as you can. And this can be very contentious. And there are some sellers who will insist, like, you are not talking to my employees until we're closed. Right. And then there are others who will say, yeah, sure, talk to them now. But it's a very, depending on the industry, depending on the size of the business, right, it can be critical, right? Because what the seller doesn't want is, okay, you talk to the employees, so now the employees know that the business is for sale, but then you don't close, right? And so the person then is like, well, this business is about to sell, I'm jumping ship. And then the seller is in a world of hurt. You as the buyer, right, would kind of like to know if those people are going to jump ship and would rather them jump ship before you buy the business anyway, right? So there's just a tension here, and it's about risk. Some people are willing to take on a lot more risk with this than I would, but it can be problematic. But when it did kill deals, it killed deals at the very end, which was frustrating this year, but still better that it kills them than you find that out day two when people quit on you.
James, David, is there a best practice here for the case where owner will not let you talk to key people? So you're just riding in, hoping that those key people don't quit. Is there some mitigant that buyers can do, like identifying the key people and getting a sense for how hard it would be to hire a replacement, for example?
Yeah, I mean, you can do research on comps, comparables. You can come in and talk about, I don't know that you would do this immediately, but you could have something like retention bonuses for people to just get everybody to stay for a while. Um, but it's also important in your diligence to look not just at the org chart. The org chart is great, but the org chart doesn't tell you everything, right? What you really care about as far as who the key employees really are is like who has the customer relationships, who has the supplier relationships, like who's the real star who does all the work, right? And that doesn't necessarily show up in the org chart. Uh,
Yeah, I think two things I would raise here. Number one is, if somebody has a lot of really good customer connections, you might not be able to just hire for that, right? It's not as easy as just a replacement. And if they're not willing to have a conversation, let you have a conversation with that key sales guy until closing, then depending on your deal structure, you might not even have an agreement with them. They might be able to just literally walk and take their customer relationships with them, right? So, to some extent, I think you do have to push back in certain instances. And the other thing, to James David's point, we've seen times where, the issue was one of the key persons. This actually wasn't our deal. This was another deal we heard about, but was somebody who just knew a lot of the technicals of how to do that specific type of business. Wasn't anywhere on the org chart, but he was a really, really key operator that everybody called when they had questions, and the business would kind of fall apart without them. So, just be aware, be careful as you're kind of thinking about this, that you really dive in operationally so that who really is important. I think this one was a little bit more you this year, James David.
Yes, sadly it was. So, and this is when we represent the buyer. If we represent the seller, this can happen too. But um, lawyers who dabble in M&A can cause all sorts of problems. That's the text I wrote. Um, this is hard, right? You've got, especially if you have a founder seller, right? They've worked with some attorney, they know some attorney. Um, it doesn't mean that it's person's an M&A attorney, right? That person could be a divorce attorney, a real estate lawyer. Uh, those were some of the worst this year, was a real estate lawyer. But what happens when you have somebody who doesn't, when we are dealing with an attorney who doesn't deal in these markets, is they will redline everything to such an extent that it's hard to even read the documents sometimes after all the red lines. And then there are other times when people fight about things that aren't things to fight about. And then we've had times when people misunderstand things and rewrite them and mangle them. And what the net result of it is for you, I mean, it's frustrating for us, but the net result for you is that it breaks down trust. Because the seller is listening to their lawyer, they trust their lawyer. And if the seller's lawyer is saying like, "Oh, this is a terrible deal. You should never do this deal," look at all the ways they're trying to screw you, and they keep saying that and they keep saying that, then the seller's going to listen to them. And we've had more than one where people just say, "Ah, to hell with it," and eventually, right, either through just getting tired of going back and forth, or the seller thinks that you as the buyer are lying or trying to cheat them, or the buyer thinks the seller is trying to cheat them. We've had that too. But it just trust breaks down and people just walk away. Trust is one of the key currencies in the M&A process. You need to build it and build it and build it as much as you can early, but eventually that trust just runs out, and seller counsel not being familiar with these markets is one of the easiest ways for that trust to that balance of trust to hit zero. There can be times when people will say, if you don't have somebody who's done M&A transactions, I'm happy to, happy to introduce you to a few people. Some sellers are actually receptive to that. You might think that's not the case, but it does happen sometimes. If you are going to try that though, you need to try it at the beginning, because once they're committed to an attorney in this process, they're not going to change, no matter how bad it gets.
Yep. All right. Well, we've got a lot of slides to get through, and so we'll probably have to be a little just
They'll speed up now.
Yeah. A lot of these are things kind of one-offs.
Now we're getting more to the one-offs, although this was more than one. So this was actually a real estate lawyer, where the person just went AWOL for a couple of months. But SBA rule changes came out in the middle of this year. Certain deal structures were permissible under the old rules, no longer permissible under the new rules. And there was more than one transaction where they really only made sense under the old rules. Once the rule changes and they weren't able to get the loan number quick enough, then the deal just didn't make sense.
Yep.
This was mine too. This one was wild. But seller entity was split in a divorce between husband and wife. The ex-wife decided to basically torpedo the transaction by making a bunch of unreasonable demands because she had veto rights in the operating agreement. Um, just to spite the husband, I think, actually. But the lesson for you, not that this particular craziness could happen, but the lesson for you is look for the operating agreement, shareholder agreement pretty early so that you know who needs to sign off on the transaction. Right. The key for you is like who can say no, right? Who has to say yes? Because if you know who those people are, then you can make it work. But if there's a surprise at the end, then that can cause all kinds of problems.
We had several deals where tariff uncertainty came in, obviously those with Chinese suppliers, but not limited to that. This also creates a situation where, as we talked about earlier, you're buying the business as it exists on the closing date, right? So if your costs have just gone up substantially and your EBITDA has gone down substantially on a go forward basis, then you're going to pay for the transaction based on the go forward EBITDA. But the seller will often not see it that way because their business was doing so great before. So a lot of times that just creates a big disconnect between what you're willing to buy the business for and what the seller's perceived value of the business is. And so, a lot of deals died simply because there was that disconnect, and tariffs also just caused disruptions in, a couple other different ways. So just something to keep out for, just FYI, there might be some Supreme Court might start limiting the ability of the president to just impose tariffs unilaterally. But even so, you should just be cognizant of different industries. If you're looking at a target, think, are they getting supplies from overseas? Is there a possibility of a tariff risk, disrupting that? And this happens sadly, several times. Just sometimes the seller just decides they're just not going to do it anymore. And sometimes it's because the process drags out longer than they expected, even though it was a normal process. And sometimes they just kind of wake up and they think, do I really want to do this thing? Um, I don't know really if we have that many things except for what was talked about before. The relationship with the seller is paramount. Having trust with the seller is paramount because, the more that relationships gets cold, the more likely the seller is to get skittish. This happened to me. We were representing a seller. The buyer, there were several things that were very strange about how the buyer operated. He sent across a purchase agreement drafted by ChatGPT, even though it was a very substantial transaction, an eight-figure transaction. And we did some due diligence where we did some litigation searches, and turned out the buyer was both the plaintiff and the defendant actually in a lot of lawsuits in a lot of jurisdictions. So basically, the seller was like, "Look, this guy, I can't trust this guy because who knows if he's getting into all these legal troubles. I can't do business with that type of person." So we just killed the deal.
And we're going to do lien and litigation searches as part of our diligence process too. And if there is litigation, then we evaluate it. This is where I get to do all of that because I was a litigator in a past life. Um, and we'll decide like if it's substantial or not. And if it is substantial, like how do we address it? Sometimes there are ways to address it, sometimes there isn't, sometimes there aren't. But regardless, in some ways it's about trust, right? You need to be able to trust the person. And so if they're the plaintiff in a lot of lawsuits, that may be telling you something. Although certain industries, litigation is just part of it. Uh, okay, we had another one, shifting regulatory. So business was really good business, actually. It just was built on a very particular moment and a particular set of regulations forcing some changes to this was in some building installation. And those regulations were just changing or sunsetting in, I think, 20 at the end of 27, maybe something like that. But the whole business was built on, helping people comply with those regulations. And with those regulations sunsetting, and it's basically just a one-time transition that a bunch of buildings are going through, then right, you're going to have to reinvent the business in 2 to 3 years. And the buyer just eventually decided, like, I don't want to sign up for a 10-year loan based on a business that I'm going to have to reinvent in two. So, you know, could he have known about all that before the LOI? Probably not. Could have known some of it. Um, but the lesson is, do research on the industry. You can, right? To the extent you can, look at, if there's been new legislation passed in that industry. You can look at proposed regulations and legislation too, but proposed and enacted are very different things. Um, but don't stop doing research, right? You're going to find more out as you get deeper into the process, and don't stop doing research. Try to talk to people who are in the industry. Try to, you know, talk to, if you get the chance to talk to people who, maybe didn't buy in that industry, right? Why they didn't, if you have access to those people. But just try to get as much knowledge as you can. Uh, this was another one of mine. Just some unfortunate things happened to the buyer post LOI. Had to spend a bunch of money on some things. Just things happened in the personal life, and at that point, right, just the balance sheet wasn't there. Didn't have enough money left to meet the equity injection requirements. Tried to raise capital to bridge the gap, and it couldn't be done. Offered a few things to the sellers, and sellers weren't interested, right? So this is one of those first, there's a few of these where just kind of stuff happens outside of the process even that can make it impossible. And this was unfortunate, but it did happen.
This one, so some franchise agreements have a right of first refusal. So we had one which was a very nice set of franchises and a very large franchisor. And when he went up to sell, they got under LOI, and then the franchisor said, "Actually, I like that." So they exercised the right of first refusal, and the franchisor just bought out those things. There's not, if you're looking at a business that has this, just know that if there is a right of first refusal, that it doesn't really pay to do any real pay diligence whatever until you get clarity from the franchisor about what they're going to do. Because you don't want to do any more work, and it sucks when it happens, but it can't always be avoided if the franchise agreement has it. So, and this happened, one time this happened this year. It actually happened as a different agreement where there was a franchisor, and what happened is that the franchisor was bought out. There was a change of control, and the new sheriff in town wanted new agreements with different provisions about how all of the terms were going to work, and there wasn't clarity that the seller's business, which was some of the best locations in the franchise, would actually continue to have the same performance on a go-forward basis given the new franchise arrangement. So the seller was grandfathered into the old arrangement, but that was coming due in a year or two, and then they'd be under this completely new arrangement with this completely new franchisor. So because of that, there was just a lot of risk. What happens? Do you start losing money? How does this all work? And at the end of the day, the buyer just couldn't get comfortable with an SBA loan to sign up for something like this. Now, I'll just note this doesn't have to just be a franchise agreement. You might be the exclusive distributor of a certain, product, right? You might have some other key contractual relationship. And if the person who has that key contractual relationship, if they change ownership, that can have a very material fact going forward on, how the business operates. Um, this is something that we see, very commonly if you are in any type of business which requires a license to operate. Sometimes it's held by individuals, sometimes it's held by entities, and sometimes even if it's held by the entity, there are requirements about who gets to own that entity. So a lot of times people are like, oh, you can have this managed service organization, that type of model. And like those things tend to be expensive. They tend to only happen when a business achieves a certain amount of scale. And a lot of SBA style deals, if you're in the self-funded search realm, aren't going to reach that level of scale. And even if you can, reach that, you have to be really careful and work with experts that know that this is the practice in the industry and that you're not going to get in trouble and suddenly have the license revoked. And sometimes you do your due diligence and you realize, this just doesn't work.
That happens. Yeah, I mean, it happens in professional services. It happens in the trades. We saw it in both this year, and there is no uniform answer as to even what industries it applies in. Right? There's some states where certain industries are fine, and then other states where those same industries, the same transaction structure doesn't work. So it really does get granular.
Yeah. Part of this is just knowing the industry and knowing those regs before you're buying into
Yeah.
it.
This was a license situation. This one was. We had somebody who, spent months looking for an operator to step into the owner's shoes where the business required a licensed individual. Couldn't find that person, and so the transaction didn't happen because you needed a person to hold the license in the kind of operator seat, and couldn't find one, so the deal didn't happen. Better to find that out on the front end rather than lose the ability to operate after you buy a business, though.
I had one that died this year. The buyer was under LOI. They actually did all the diligence. The diligence checked out. And then after that was done, the buyer got an offer to work at an independent sponsor roll-up transaction that was doing just incredibly well. And it was just an opportunity that was so much better than buying one of the smaller, businesses. And he felt really bad about it, but he just was like, I'm sorry, but this is, I have this much better opportunity. So, that happens. That's part of life. It's something you can't necessarily plan for. I would just say communicate that early to the seller because it's only fair to them. If the seller has incurred costs, you might make a good faith offer. You don't have to, the LOI says every party bears its own expenses, but I personally felt kind of bad for the seller because they had to do a phase two and, because of some environmental stuff and they went out of pocket for it. And then, the buyer walked away and that felt really bad. So, just be very considerate if this does happen.
Yeah, not that that's going to happen often. That one was definitely one of the one-off reasons.
Yeah. So here we'll just kind of mention a category of businesses where this happens a lot. Businesses which have large vehicles fleets. So this happens a lot in non-emergency transport, medical transport. I think transporting people to and from their appointments. A lot of those vehicles are often aging. And so you look at EBITDA, the cash flows look great, but you're going to have to replace those vehicles very soon, and it might not be easy to replace them. There can be other businesses that are capital intensive as well, but just do not confuse EBITDA for cash flow especially when you're dealing with a business that has important things that need to be replaced, like vehicles or like big equipment.
Yeah, it's the EBITDA, the D and A, right? Depreciation and amortization. And there's certain businesses where those two letters, those two parts of the acronym matter a lot. Um, Trucking, right? If there's a trucking industry, this happens too.
Yeah.
Um, and it can be handled correctly in the accounting, right? But what should happen from an accounting perspective is you kind of have reserves to buy new vehicles every year. A lot of times people don't do that in their books, and then when you make that adjustment, the deal no longer makes sense.
And this is a real niche one, but it happened twice this year, maybe three times. But if you have a business that is selling like cars, but usually it's not cars because you kind of know it with a dealership, but it's often things like ATVs or sometimes it's farming equipment or like tractors. A lot of times there's specific things called floor plans that, you're not just buying those vehicles, you're essentially borrowing them and then you're paying them off once somebody goes in and actually buys it, right? Those floor plans can make financing very difficult from an SBA perspective. A lot of this can be very tricky. And so you can sometimes have businesses that look like they're doing 1.5 million EBITDA, they look like they're doing really great, but then they have these very difficult financing structures that make it difficult to finance the deal. So just be wary if you see that, if they're selling things that are, vehicle-like, then you're probably going to run into an issue like this and it's going to be difficult. It's going to be more difficult to get the deal done.
For a mental image, guys, on that one, that would be like a dealer
Yeah,
type business, a
you're
tractor dealer
dealing, yeah,
or a
you're selling ATVs.
ATV dealer. Yeah.
Yeah, tractor, exactly.
Yeah.
Yeah.
And we have finally reached the end of the pain. So, um,
Not as grim as I thought it would be.
well, it was for us, right? It's all stories for us, right?
Yeah.
Each of those, but as you can see from the kind of overall, right, there's sort of the big themes are, right, financials just don't check out. But then the theme to take away from the last portion is like there are certain things in certain industries, right,
Yeah.
to really key in on, and those vary by industry. Uh, but if you are looking in some of those industries, then right, those become very important and sort of gatekeeping, right? We want to do this first type of issues.
Yeah. This is also why it's good to not to just pat ourselves on the back, but this is why it's really good to work with advisors that do a lot of deals because they can help you spot these issues early. And so we've had several conversations with people. We didn't even engage them as clients, but they came into us with a signed LOI and we said, well, what about this? What about that? And they quickly realized that there were issues they hadn't thought of and they needed to resolve. And sometimes the deal ended up dying a week later, but that was a lot better to have that conversation with us, free consultation call essentially, than, whatever the alternative would be if you work with somebody that wasn't familiar with those type of issues. So
Great, guys. Good stuff. Got a bunch of questions here, although not as many as usual, because I think maybe some of these reasons were not, maybe today wasn't as technical, maybe. What do you see? Could you say more about kind of good faith deposit, earnest money deposit, breakup fees, anything where there is a financial penalty for a deal dying?
Yep.
How anything? What do you see?
It's a real estate construct that has no business being in business acquisitions. I hate them. I abhor them. I it's not in our forms. I don't like it. We have clients who will do it. We do have clients who agree to it. I always tell them not to. Um, and the reason is, right, the most common by far, right, the most common way these deals fall apart is not something that is in your control as the buyer, right? It's the financials weren't as reported. That's reason number one. It's reason number two. It's reason number three. And there's just no reason why you as a buyer should be penalized for that. Uh, so it tends to come up more with people when there's a real estate broker involved in the transaction who is moonlighting as a business broker. Um, but I have very strong opinions and none of them positive.
And I think another thing is whenever we see that, I mean, obviously we try and strike it. Another thing you could counter with is like, well, what about my expenses that I'm going through? Because I, as the buyer, are actually having more expenses. Seller, how about you put some money into escrow, right? If there's something wrong. And that can be kind of an interesting, startling revelation for seller. I will say there have been times where the seller has just gotten burned by a deal that collapsed in the 11th hour. And we negotiated to have something where, it was essentially refundable for all reasons, except for if we just sort of, the buyer just decides to walk away. And we ultimately got comfortable with that because of that refundability. Again, we don't love it, but if you do have a seller that just has had a really bad experience recently and feels like they have to have it, first of all, don't agree to anything without talking to a lawyer. And secondly, you want to make it as easy as possible because if those financials come back, at all different from what was reported, then there's no reason they should keep your deposit.
It also matters a lot who holds the money. I'll
Yeah.
just leave it at that.
Yeah.
Is it common for sellers to be willing to share their operating agreements or shareholder agreements? And if so, at what point in the process?
It's post LOI, and yes, we're gonna have to see it.
I mean,
If
it
they're
seems like it would be
not,
a pretty key item that would need to be scrutinized because there's all
It's
kinds of stuff that could be in there.
yeah, I think it's probably item number 2 on our diligence list, to just not in necessarily in importance, but just the way it's ordered. It's one of the first things on the list.
yeah.
Great. Okay. Um, on leases, going back to whatever that was, maybe number 4.
Yeah.
I've heard from my lender that if the business isn't reliant on the current location, current lease location, you can get a waiver on having a full term lease agreement. Respond, please.
Yeah, it's a little bit this is one of the things that was one of those under the radar changes in the June updates. Um, but it is true for certain, right? There's a lot of caveats to this, right? If you're doing a manufacturing facility, this isn't going to apply. But if you're just the sort of thing like you're renting an office in a strip mall, right? Kind of that sort of archetype business, then there can be situations where the lender can waive this requirement, yes. But even then, it's a it's a an optional thing. It's not a mandatory thing, right? So your lender could still force you to have 10-year options, um, and that's the default. So even though it is possible for some businesses now, um, not every lender is willing to. Not every lender updated their policies based on the new allowances in the SOP.
Yeah. And we found that a lot of times when those deals did die, it was locations where it actually did matter. Like I think there was one that escaped the room location where that's like a place. And the other ones, the locations tended to matter. So it's true, but we don't find that landlords of those generic offices, they're often not fighting because at this point, a lot of times, frankly, they're struggling to get tenants. So, you know, just keep that in mind.
Are most buyers receiving updated monthly financials while under LOI through closing? Good question.
We find, yeah, most often, and if not, then they should be requesting them. Usually, every time the month closes, it's just like, okay, send the updated QuickBooks and let's just look at it and see how performance is tracking.
Do you guys have a checklist for pre-LOI information a buyer should gather prior to engaging with an attorney?
No. And it would unfortunately be impossible to make such a list, I think, because every, whether you're in an off market versus on market situation, right? It just depends on the level of information that you have, right? A business listing, those can be wildly different. What's in a sim can be wildly different. Uh, so, I mean, you'd like to have as, kind of get as much as you can, but understand you're not going to have everything you want, and definitely not before an LOI.
Good place to insert how you guys feel about when to engage with you or whatever counsel.
Yeah, so a lot of times, feel free to reach out when you want an LOI template. We have an LOI template that we give out. We also have videos of us filling out the LOI template so you can get a sense of that. We try and have people be kind of independent between our videos, between our LOI template. They can kind of get themselves up and going pretty well. When we usually like to be engaged is when you are, kind of in the not just sending out an LOI, but you're sort of in the finalist stage where you've maybe gotten some comments back from the LOI, or certainly if you have a signed LOI. That's kind of the ideal time to bring us into the conversation and and start working with us. We would love to talk to more people. Unfortunately, just given how busy our schedules are, a lot of people who reach out to us at the beginning of their search, I wish I could meet with all of them, but we're so busy that a lot of times we're not don't have the bandwidth to do that and still do what we need for our clients. So, some people say you have to have your attorney at the beginning of the search. I just don't think that that's accurate. I think that there's enough materials online that you can do that. And then sometimes we have people reach out if they have specific questions because there's a deal that's uniquely hairy, and we can sometimes help them out with like something like that.
Yeah, but if you are at the beginning of your search, go ahead and reach out, and it's a template response that you'll get, but it will include a number of resources. So
Exactly. Reach out to our website. You'll get all these resources, and then um, and hopefully that'll help get you most of the way there.
Any suggestions on how we could do a side deal of some sort so that the seller can keep 20% of the business now with the SBA, with the new SOP by the SBA?
yeah, I'm not going to help you do that. Are there ways to do it? Yes. But I'm not going to talk about them, and I'm not going to help you do it. So that's that.
Yeah.
I'm not gonna write something that I know is not in compliance.
Yeah, whereas effectively defrauding the bank in the process.
Great. In my 2 years of searching, I've met only one or two sellers willing to introduce buyers, me, I guess, to key employees. How do you suggest raising this with sellers or brokers to get them on board with introducing
Well,
before closing?
yeah, it's going to depend on the timing. I mean, nobody's going to do it pre-LOI. Um, sometimes, sometimes it happens where there's a gap between signing and closing, and it happens during that window. Um, there can be, you can write a purchase agreement such that it is contingent upon you as the buyer having employment agreements with certain individuals in place as of closing. Or you can make employment agreements with key people a closing condition. Um, there can be pushback on that, certainly, right? Because the seller is going to say, well, I don't control that. And you as the buyer say, well, you control it probably more than I do. Um, so a closing condition can be a way to force the conversation.
Are there techniques that can save a deal where earnings are poor or performance is declining? Some sort of earnout for the owner if the business does well? Any tactics, techniques like that?
Yeah, if you are in the SBA world, you are limited uh, in your options in terms of what can get, what can be in an SBA deal, and right, because even if you do like let's tack on a seller note, like let's have an extra seller note, it has to get through underwriting as if all of that is going to be fully paid, and so the numbers don't always pencil from a debt service coverage ratio perspective. If we're outside of the SBA, yeah, there's all kinds of things we can do. But if you're in the SBA box, it's a lot harder because you just have to fit in the deal structures that are permitted under the SOP.
Yeah, sometimes in distressed deals, you get a pure earnout. There's no cash at close. It's just, you know, just based on future performance.
But, and why couldn't in an SBA context it just be a very large seller note is a very large piece of the deal and it's forgivable?
Yeah, because when they do their underwriting process, the deal will be underwritten as if the full amount will be paid.
Yeah.
And so if the historical financials are trending down,
They'll
query
pro
whether,
forma that.
query whether it's going to be able to meet those payments. Often it doesn't.
Hmm. Okay. Um, you guys mentioned some litigation prone industries. Can you rattle off a few examples?
Anything in construction, uh, just construction, which often isn't litigation. It's usually arbitration. There's actually special arbitration rules for it. Uh, but just because you have multiple layers of contractors in that industry, and so if something goes wrong, everybody sues everybody else, and it gets arbitrated. That's probably where it's most common. Um, but there can be other things, if people are having to go after customers on a regular basis, then that's a problem, right? Or if you've had litigation with a key supplier, right, that could be a big problem. But the industry where it's most common is just construction broadly construed.
What types of additional financing do you guys like? Do you guys like when it comes to a deal that's over the $5 million SBA cap with no real estate?
Well, if you get big enough, obviously you can, 2 million EBITDA and above, you've got SBICs and those sort of things. Um, if it's above the 5 million, sometimes you have pari passu financing within the SBA context. And then what we find is there's this kind of dead spot where, it's above 5 million, but it's less than 2 million EBITDA. So, kind of in that in between space. And if you can't get pari passu lending there, which often you can't, you can get some more traditional financing, but usually the buyer needs to have a strong balance sheet. So they need to have like real estate they can pledge, other assets they can pledge. They'll have a much stronger operational history. So probably be putting a lot more equity into the deal. So it does happen, can happen, but usually it's a different profile of person than, just your standard, searcher or even sponsor for that matter.
The seller will not provide IRS returns, tax returns. Have you ever closed a deal without tax returns?
I would never do it because number one, what are you hiding? Well, you can't do it in the SBA because they won't do it. But number two, yeah, what are you hiding? Are you a tax cheat? And if that's the case, that goes to the question of seller integrity. Or are you reporting that there's actually a lot less income, at which time that makes you wonder about the profitability of the business, right? People, if you have a big tax return and you're paying lots of taxes, that means you're making lots of money. That's a great thing. I mean, it's not great to pay taxes, but it's a great thing for you as the buyer.
how is working capital requirements negotiated pre-LOI or causing issues, or how does it cause issues between buyers and sellers
Yeah.
post-LOI?
It causes issues at every step of the process. We didn't even include working capital as a reason deals fell apart in
Oh
this
yeah.
presentation.
I
Interesting.
don't think that we had a deal technically fall apart because of a working capital dispute this year.
Hmm.
It was
Okay.
amazing.
Well, I think we might though. We've got a couple that are
We've got
You
some in
got a
the
couple
hopper.
weeks. You got a couple weeks left in the year.
we've got a couple that are could go either way.
Boy.
But anyway, um, one of the big problems for you as the buyer is if the seller and or broker wants you to commit to a working capital number pre-LOI. Because if you commit to that number, you're probably stuck with it, regardless of what the working capital needs actually are of the business. Because whatever they say the working capital is, it's going to be too low almost every time. Um, it often, you don't have the numbers, so you really shouldn't be talking numbers pre-LOI. To the extent you can, right, try to establish the framework early. Right? If we can agree on like, here's what's going to count, here's what's not going to count, here's what we're looking at, and then the numbers are what they are. Right? The closer you can get to that sort of outcome, and the sooner you can get to that sort of outcome, the better. Though even then, right, people can see the final numbers in bulk. Right? It does happen, but you want to try to get to a framework as early as possible on working capital.
And this is probably a place where dealing with good advisors really does help you out, because I think one of the reasons we didn't see so many deals die on because of this is because these issues, we tried to address those early. When working capital issues are addressed as like, oh, I'm going to put in the number, a week before closing, and that's not the number that the seller was anticipating, that's where you see deals die a lot more readily. So yeah, have that conversation early, to James David's point.
And can you give an example or two of a framework that's common in these deals?
Yeah. So, I mean, that some people,
Average
yeah, I
over.
mean, the easiest is often like a SaaS business, right? A software business where it's sort of it can be as simple as, okay, this is how much it costs to operate the software plus this is the employee expenses. This is just sort of OpEx. And we're going to do 3 months of that, whatever that number is. Good enough. That's about as simple as it gets. So yeah, simplest would be just don't do it. But then there are others where you're taking the average, right, a historical average, right, a trailing 12-month average, let's say, where you take snapshots and then average those. You can also do the low or the high of different metrics, but say like the trailing 12 of AR and AP. We're just going to kind of balance those. Maybe we don't, maybe we include inventory, right? Inventory as part of this. Maybe inventory is treated separately. Sometimes they're broken out separately. Uh, but it's often, an average or could be a high water mark of different things. But yeah, sort of a trailing 12 framework. And then it's about, okay, what categories are included versus excluded.
Right.
Weirdly, some people want inventory to be separate. So
Yeah. Well, so sometimes, if they have a lot of excess inventory and that gets counted towards working capital, that could lead you into a cash crunch because you might not have accounts receivable, which is actual cash coming in. You have a bunch of inventory you can't sell, and that doesn't necessarily help you. You know what I mean? So
there are ways to cap that and handle that too. But
exactly.
Last question. So, guys, are there deals that deals die at the same rate across all industries, or are there industries where you see deals die more or less?
They definitely die at very different rates. So, some of these risks, right, like key dependency on key employees is much higher in professional services, marketing agencies, trades. So those deals tend to die more often for those specific reasons. I think I would say manufacturing deals tend to die less because it's just you tend not to have as much of an issue with key employees. You're kind of selling a widget and the widget is, doing the thing. Um, but and then there are certain industries like e-commerce, which, James David could speak to that, but like certain industries, people that aren't experienced in them really should be very cautious about playing in at all, frankly. So,
Yeah. And then, we talked a little bit about non-emergency medical transport, and that's an example. I think we went 0 for 3 this year
yeah. Yeah.
Oh, wow.
in that one, all for the same reason that we talked about it being too much
CapEx.
vehicle fleets, but like 0 for 3 for exactly the same reason in a particular industry. Uh, so there are just outlier things like that.
Yeah.
Great, gentlemen. Well, we will call it there. We got to a lot of the questions today, but of course, not all of them, never. But great presentation. As always, great presentations all year long. We look forward to, do we have any sense of what January will be, Bill or James David, the topic for the next webinar?
Well, usually at the beginning of the year, we do sort of a starting your search situation. Basic things you need to do. So probably something like that, but we'll stay tuned.
So the birth of deals at the beginning of the year and the death of deals at the end of the year, and the whole life
Yeah.
cycle, it maps like that. Great.
An arc.
Yeah.
Well, thank
something
you.
like that. Yeah.
Thank everybody, audience, for coming. Thank you for your attention. We have been recording as always. We will send out the recording. We will send out the slides. You're probably wanting a list of all of these, so you'll get that in the slides. We'll send that out today or tomorrow. Bill, James, David, thank you guys very much for a great presentation. And we'll see everybody in the new year. Happy holidays. Happy New Year.